There are some common investing mistakes which every investor does when they are new to the market. There are two ways to avoid that mistake. Either you stay in the market, you commit those mistakes firsthand, and then they try to learn from your mistake, or you learn from people who have already committed that kind of mistakes and they share their experiences, and based on that, you learn how to avoid that kind of mistake. I am CA Vijay Kedia, and in today's video, I'm going to share 5 common mistakes which you should must avoid if you want to become a successful investor and create wealth. So stay till the end of this video, and I'm sure this is going to be very helpful in your investing journey. The first mistake which I want to talk about is about investing without any goal. So whenever you are starting your investment journey, you should have a financial goal in place. So why you are investing? When do you need that money? Right? So if you are investing for any goal, whether it be buying a house, buying a car, your kids' education, your retirement, you should make sure that that goal is at least 5 years away. So if you need that money in less than 5 years, then definitely you should not go for equity investment. So there are other investing avenues like debt mutual funds, gold, where you can invest instead of going for equity. Because if you invest for a goal which is less than 5 years away, and market, it will be volatile, it goes up and down, so you'll not be able to handle that volatility if your goal is approaching, and you'll panic and you will try to redeem your investments when the market is down, because you don't have that much time, right? So you need that money right now. So you should have a financial goal in place that, okay, I need that money beyond 5 years, and then only you can plan that I'll go for equity investment, so that you can handle the market volatility, you can stay disciplined, you can stay invested, and that will help you to create wealth. Because if you just come to the market, put that money, and then you suddenly need that money, and you'll panic and you'll take out when the market is down, and that will not help you to create wealth. So having a financial goal in place is very important. Second thing which I want to talk about, and which is a very common mistake for every new investor, is trying to time the market. So what people do is, when the market is running sideways or market is in downturn, they stay away from the market. But suddenly when the market start picking up, and they see that the returns are coming, and they wait for like 6 months, 1 year, when the market is going up, and then they enter into the market. But the thing is, by that time, market has already given the returns which it's supposed to give for maybe next 1 or 2 years. When they enter, and in few months, then the downturn starts, and then they get trapped. Similarly, when the market goes down, that time you should stay invested. But what they do is they panic and they try to exit. But the fact is, you should be entering into the market when the market is running sideways, because that is the time when the market is consolidating and it's gearing up for the next upward trend. But at that time, a new investor will not show interest, and they'll show interest when the market is already running upwards, and then there is a limited scope for upside, and that will limit your gains from the market. The idea here is that you be a little greedy when the market people are fearful, you enter in the market, and you stay invested. Even if you see after an upward trend there is a downward trend, you stay invested, because it will be followed by an upward trend, and then only you can make that gain, because you have that time in place, right? So you have invested for long term, your financial goal is more than 5 years away, so you can take that risk, and then only you will be rewarded. So let me explain that user behavior or investor behavior with the Nifty index. This is the Nifty 50 chart for the last 5 years. And if you see here, after the COVID dip, the market had given a very good return, and a lot of investors entered into this market. Uh, and this market kind of peaked in October 21, where it crossed 18,000 levels. But then from October 21, it started its downtrend, and at one point in June 2022, it was 15,000 level. So it has almost corrected 15% in 9 months. So, and this is the time where most of the investors moved out of the market, especially the investors who were there for the short term. And then if you see from here, market recovered, but again like went down, went up, right? So if you see till March 23, it was running kind of sideways, right? This was also a good time to enter, but the investors were uh, thinking that we are not getting any return from the market for last 1 year or more than 1 year, and nobody was interested in making fresh investments. But if you see, after that market picked up. So in 23 second half, it had a good run, and which continued in 2024 as well. So in 24, users started entering. So by end of September 24, we crossed 26,000, and then again you see the downward trend which is happening, and we have already down by more than 10%. So what happened here is, the use, instead of entering in this phase, which is like 1.5 years of like market running sideways, users entered when the market was already in upward trend. And and then there is a limited scope for gain here. So say if you entered in May, maybe you gain till September, but nobody can time the market that it will go up from here or down, and then started going down. So if you see, last 6 months of returns are gone. So from June to December, if you see market, there is no return, right? So and then people get frustrated and they exit the market. But the ideal time to enter the market is when people are not interested in the market, and when everybody is getting interested and they are entering the market, and that time you should be fearful, and you should follow control investment through SIP instead of going for lump sum investments. The third and very important investing mistake which I want to talk about is investing based on tips or chasing some hot stocks. Because what happens is, when people are new to the market, they look for tips, and that, okay, what is the stock, where should I invest, or and they, based on some random recommendation, they go and invest in that stock. Sometimes they chase some stocks which is already has given a good run up. It's already it has become 2 3 10 times, and they are trying to chase that stock, that it will continue that kind of performance in future as well. So that doesn't happen, right? If you invest based on a trend, or you invest based on a random recommendation, that's not going to help you to create wealth. There are more chances of losing money in that investing approach rather than making money, right? So if you're new to the market, you stick to index fund, you invest in mutual fund, and slowly you develop your understanding of how to read companies fundamental, and based on that you go for individual stock investing until you are able to do your own research. And you should not go for individual stock investing, right? People start from stocks and then they try to move to mutual fund after burning their fingers. But it should be other way around. You should start with mutual funds, and in the parallel you should try to develop your understanding, and then only you should go for stock investing. The next point which I want to talk about is overtrading. So what happens is, when the new investor enter the market, they buy some stock, and luckily that has gone up by 10 20%. They think that I should redeem my investment and book my profit. But that's not the right approach. If there is a stock which is doing well and the company is good, it will increase further in future. So if you just book profit for 10 20%, you lose that opportunity to create wealth in the long term. And then they sell one stock, then another, they buy a different one, because now they think that that is a good opportunity. And then when that stock goes up by 10%, they redeem. But that opportunity can backfire. So sometimes you sell that good stock, move to another stock, and that stock goes down, and you lose whatever profit you have earned so far, right? So that over trading, right, frequently buying and selling, it doesn't help. So even if you have identified good stock, but if you don't stick to that, then you lose that opportunity to make money. Because I have done the similar mistake in past, where I was able to select good stock, but when I got 20 30 40%, I came out of that stock, booked my profit, and that became 3 4 5 times. And sometimes people even do start doing that intraday trading, where they buy and sell stock on the same day. This is like a very serious thing, because Doing intraday trading requires a very different kind of skill, and not everybody can do it. And most of the people who are doing intraday, they lose money. So definitely it's not for the new investor. So that is something you should definitely avoid, because if you are a new investor or an average investor, over trading is not going to help you. You should just buy stocks and mutual fund for the long term and stay invested. And it's boring, it's not exciting, but that's how you are going to create long term wealth, not through over trading. And last but not the least, the investing mistake which new investor do is ignore diversification. So what they do is, whatever money they have, they start investing in the equity market, and without looking at their risk profile. If you are putting all of your money into stocks or mutual funds, and you don't have any additional cash for your emergency funds or any short-term requirements, you might do a panic selling when you need fund, and then that will not be good for your long-term portfolio. So you need to diversify your investment as per your risk profile. So you need to understand that diversification is very important. So you need to see how much of your total investable corpus you can put in equity. The thumb rule is that you can put 100 minus your age, that percentage you can put in equity. So if your age is 30, you can put 70% in equity, rest should be in other asset class. But again, that will depend on your risk profile, but that's just a thumb rule. So because apart from equity, you can go for investing in gold through ETFs. You can also invest in debt funds. You can keep some emergency cash in liquid funds. So there are other investment opportunities which you can utilize to maintain that debt or non-equity portfolio, right? So that is something which you should not ignore, that you have a right mix of assets in your portfolio, and you are not just focusing on equity, which can be volatile in the short term. So I've already made a video on how to make a diversified portfolio. You can check that link in the description, and where I have also shared how I have diversified my portfolio across different asset classes. And once you create a diversified portfolio, you should also take care to rebalance that portfolio. So for example, you are going for 70% equity and 30% is invested in debt, gold or cash, and then market goes up and your 70% becomes 75% in equity. So in that case, there is a need to rebalance. You should redeem some of the equity investment and move that to debt or other asset classes. Similarly, when the market goes down and your say equity allocation came down from 70 to 65%, you have additional cash to deploy. Use that cash and take your equity investment to 70% or whatever is your target percentage. Because, and that you need not to do very frequently, but if you do at least every year, that should be good enough to keep your portfolio balanced and diversified, and that will help you to stay invested for the long term, and that will help you to create a long term wealth for yourself. So this is something I wanted to share based on my experiences, and I hope you like this video. If yes, please hit the like button, subscribe to the channel if you have not done already, and do share with your family and friends who can also benefit from this video. And do let me know in the comments if you have any questions, queries, or you want me to make a video on any specific topic. And I'll see you in the next video. Thank you.